Hi guys, let's finish up the life insurance policy illustration. Today we're going to talk about a few big items. For example, what is the difference between term life, permanent life insurance? We talked about this before, but I want to give it more details. Generally, a lot of people have been recommending you that to take the term life insurance when you're still young, when you still are making money, right? That kind of disagree. I still think that the best option is universal life insurance, which is a part of a permanent life insurance. Remember, permanent life insurance has two options. One is a whole life, another is universal life. And within universal life, we have a different categories. We have a traditional universal, we have an index universal, we have a variable universal, right? So, but anyway, let's forget about those details. Let's look at just the three things: term life and permanent life, which is divided into whole life and universal life. I would say that overall, the best option for most people is to get a universal life when you are young. The reason, let me give you the reason. People are saying, recommending term life, they always say, well, you can always convert that to a term life to a permanent life, right? That's true. And even though, even actually, you don't have to. Usually, when they convert you to a permanent life insurance from a term life, you don't need to go through the medical exam. A lot of people say, "Wow, that's a great convenience," but I don't think that's a big deal. You remember, the one problem, kind of a biggest financial problem with term life insurance is that you never get any cash value. Remember, term life is use it or lose it. If you don't die after 30 years of a term life, the policy goes nothing. You don't get a penny out of it, right? And your loved one that got a penny out of it. So that's one problem with the term life. That same thing is true when you, after 30 years or 20 years, you convert your term life to a permanent life, you still get all those 20 years, 30 years with term life, get you zero penny. You don't get a one cash value out of it. So that's the thing. To me, that's a kind of a waste of money, a waste of your time, because all the time that you can make money, you are the high, you're on your primary career life, and you still did not get a penny out of it, except the death benefit. Death benefit is for your loved one. There's no cash value to talk about. You cannot borrow money. You cannot make that into a part of your living benefit. All you have is the death benefit. That's kind of a very limiting, right? So I would say, if you ask me, I would say no matter how young you are, get a universal life because it gives you the flexibility. The death benefit. Remember the three flexibility that I was talking about. Number one, death benefit it can be changeable, and premium each time each month you pay can be changeable, and your investment option is flexible. So you have a double or triple flexibility. And then the best part compared to the term life is that you can get cash value all the years that you spend on universal life, because universal life, remember, it's a part of a permanent life. So it carries both death benefit and living benefit. So you can take care of that. You don't get a waste in terms of getting a cash value, in terms of getting a life benefit, living benefit. So this is the number one reason for me to recommend everybody to get a universal life, and then you have a flexibility. If you're unemployed, you can reduce the amount of premium, so those kind of things. So that's the number one choice. Number two issue that I want to talk about is that we haven't talked about this in the illustration, life insurance policy illustration. You have to keep in mind a lot of things on the illustration. It's based on some assumptions. The assumption of interest rate is keeping, at the assumed level, and and so that's why you cannot really take care of it. The only thing they can guarantee you is that they will guarantee your, if it's a home life, right? If it's a whole life, then your death benefit is guaranteed. And also, they also give you something like something called like a guaranteed value or guaranteed premium. These are all fixed. So that's why, because it's fixed, the insurance company will have a risk because they have to deliver that. Otherwise, they'll get into trouble. So that's why they will make it low. So they will say that we can guarantee you get like a 4% of the investment return each year for 30 years or for the entire life, right? But they don't want to add to anything flexible part of it. For example, interest rate may be changing, and dividend may be changing. So you get whatever you got a guaranteed value or guaranteed premium. They're all kind of a conservative. Okay, so that's why you keep that in mind, that you don't think that that everything you see is what you're gonna get. Okay, you may not get what it. Usually, they will guarantee, if it's guaranteed that they will get it no matter what. Okay, they will deliver, but not for non-guaranteed part. That keep it flexible. Okay. Another terminology is that in the illustration or in the policy, they always call that, let's say, 1 million death benefit, 20 pay, so you may think that the 20 pay, wow, I only need to pay 20 times. If I'm paying monthly, I'm only need to pay in 20 months. No, that's not true. When in the terminology of a life insurance, uh, 20 pay means you pay 20 years. So each pay means 1 year. Okay. So 30 pay means that you pay 30 years. But remember, I told you that usually you should avoid paying premium until you're 100 years old. Sometimes the insurance company will make that a default. Make sure you check that. And you say, I don't want to pay that much because by the time I'm 100 years old, my loved one all grow up. They are financially independent. I need some money for myself. I don't want to, keep paying the premium until I'm 100 years old. So that's not a good policy. But remember, when you hear the word 20 pay, 30 pay, 15 pay, each pay means 1 year. Regardless, it doesn't matter. You pay the premium monthly, quarterly, semi-annually, or annually. It's always 20 years. So that keep that in mind. The other thing that I haven't talked about is that mortality table. So when you have a cash value, right? Sometimes you want to get a loan. It's called a policy loan. Remember last time I told you that the policy loan has some favorable conditions. Number one, they never check your credit history because your money is there. Your cash value is your collateral. So they won't check your credit history. Even if you have a credit score of 400, they don't mind because your money is there. It's already there. So you can get it. You don't have to go through that hassle. That's one thing. Number two is that the terms, the conditions of your policy loan usually are favorable. Your interest rate is lower, significantly lower sometimes. Okay. So the problem is that the question is that how much money can you get? Last time I mentioned the condition that for most insurance carriers, they only allow you to take out a loan of 80 to 90%, 90 to 95% of your cash value. You won't go higher than that. But then here's the question: how much? For example, you are old, and then let's say you are like 65 years old, and you want to have some loan to pay your long term care, right? So how much insurance company will be willing to lend out the money for you, even though your life insurance policy is supposed to cover your entire life? So the key is that they will look at the mortality, also known as a life table. So a mortality table is simple. It's just based on your age, based on your health condition, they will figure out how much longer you'll be living, right? So if you have let's say they have for every age group, they have a detailed life expectancies. Basically, that's what the mortality table is about. It have all the life expectancy for different people of different ages. So let's say you are 65, and then the life mortality table says that your life expectancy is 80 years old. That means that they expect you to die at age 80. So you're 65, and you have 15 years left to live, according to the timetable, right? To the mortality table or life table. So that's how they basically calculate that how much they're willing to lend the money out to you ahead of schedule, because they don't want to do that that happened that lend you all the money and then they ended up paying the rest, paying the 15 years of the life expectancy. They don't want to do that, so they will make sure that you will live the only 80 years, and then based on that they calculate how much money they lend to you. So those are the major thing. I won't get into too much details about time value of money. How much interest they charge you. We'll figure out. Usually, that's enough for you to understand the life insurance table illustrations.